A few weeks ago, right before earnings, I uploaded a video regarding Apple's valuation risk. I also bought a put option for around $250 and I sold it the very next day for around a 700% gain, which is around $2,000. That sounds great, but Apple wasn't finished with me. I shorted them and they shorted me back. I went training the next day and as I kicked my boxing bag, my iPhone 14 flew out of my pocket and completely shattered. So the very next day, I went and bought the 17. So you could say that some of that money I made went straight back to Cupertino either way. A one-day options trade and a long-term investment are two completely different things though. So instead of celebrating the trade, I want to look at Apple's numbers and ask a more useful question. Is Apple actually attractive now after the price drop? In my original Apple video, the stock was around $340 and the market value was close to $5 trillion. My argument was not that Apple was a bad business, in fact, the financials were excellent. The problem was the price that investors were paying for that quality. Using the 2029 earnings assumption from that video, I calculated 4 simple valuation scenarios. At 20 times earnings, Apple was worth around 260. At 25 times, 330. At 30 times earnings, around 400. And at 35 times, roughly 460. At 340, even a 25 times multiple in 2029 left the stock almost unchanged. That was the core of my concern. The company could execute extremely well, and the investment could still deliver a weak return if the valuation normalized. Fiscal third quarter revenue reached $109 billion. Diluted EPS increased by almost 30%. iPhone revenue grew 22%. Mac grew 29%. And services went up by 12%. Those are very strong numbers. But the market was looking forward. Apple guided to roughly 9 to 11% revenue growth for the September quarter, below the approximately 12% Wall Street was expecting. Management also warned that component shortages were limiting supply, while higher memory costs were creating pressure. Apple went down by around 8%. That single day move is what transformed my one day put from a 250 option into something that I could sell for $2,000. Now let's do the fair test, and I'm not going to move the goalpost by changing the earnings assumption after the stock fell. I am going to use the exact same $13.15 as the 2029 EPS assumption, and change only one thing, the starting share price, which is around 306. At 20 times 2029 earnings, the target remains around $260. From here, that would still mean roughly 15% downside. At 25 times earnings, the target is almost 330, and that is now about 7.5% total upside. At 30 times earnings, the target is 395, that is about a 30% total upside. And at 35 times earnings, the target remains 460, which is around 50% total upside, or roughly 14% annualized. So the valuation has clearly improved. But the interesting result is that the 30 times case still does not quite produce the 10% annualized return from today's price. Under these same assumptions, the entry price that would produce roughly 10% annually to a 400 2029 target is around 290. So, has my view changed? And the answer is yes, because price matters. And at around $340, the valuation model gave me very little room for error. Around 306, now we have a much better risk-reward ratio. Not to mention that Apple's underlying quarter was much better than the stock reaction might suggest. Revenue and EPS growth were excellent, so this was not a broken company kind of report, but I would still not call the stock cheap. And the reason for that is that a 25 times multiple for 2029 doesn't give us any real growth from here. While the 30 times case does produce some sort of a return, but it's not even a 10% annual return when we don't take into account dividends or buybacks from Apple. So if I wanted to buy Apple stock right now, my question wouldn't be, is Apple extraordinarily, outrageously priced right now? My question would be, does the current price provide enough return for the multiple risk that I am taking? I am obviously very happy with a 700% return in one day, even if the amount was tiny. But I don't want to confuse a successful trade with proof that I understood everything correctly. My put worked because Apple moved violently at exactly the right time. But the investment thesis has to survive a much harder test. Earnings, cash flow, and the valuation that investors are willing to pay for years from now. At around $306, Apple is much more interesting to me than it was at $340. But if I were to use my same assumptions from my previous video, I would still want to get in at a sub 300 level price. And that is basically the difference between being right on a trade and being right on the valuation.